Welcome to Old Fashioned Finance, the podcast that mixes cocktails and high finance. I'm your host, Caleb Frankert, and I'm joined by my good friend and fellow money muddler, Jason Burnell.
Caleb, can a podcast about finance be entertaining?
Not without alcohol.
All right, let's mix it up. Yeah.
We were mixing it up just a second ago.
We were. Oh, yeah.
We were
arguing about Disney movies.
We were almost, what's the term? Throwing hands.
Throwing hands. Yeah, I mean, I don't have a deep, passionate love like a lot of people do for Disney. So,
all right, so
that was the argument.
I'm not, because I think there's Disney people.
Yes.
I would not call myself Disney people. My wife.
Yeah.
She might think she's Disney people, but there are Disney people.
Yeah.
They only go on vacation to Disney.
Yeah, that's sad, actually.
We're dangerously close, maybe, because this will be our second spring break in a row that we're going to Disney. Mm-hmm. We had such a good time.
Yeah. That's okay.
But I still wouldn't say Disney.
I still love you.
So yeah, we're going to Disney. I think you said something about why you hate Disney so much. Yes,
yeah,
that's right.
I did. Well, and I said, growing up, if you think about the Disney movies that came out, I was born in 1982.
Which was not long before I was born.
Yeah, and so we pretty much agreed the first Disney hit didn't come out till 1994.
All right, so no, 91.
Was it?
Yeah, Beauty and the Beast.
Oh, Beauty and the Beast. Yeah, I skipped that one.
Although that was not one of my favorites.
I mean, I was 9. I was already
I hear your point.
I was a little boy. And
I hear your point,
I didn't care
Jason.
about a Disney princess at that point.
And I think I'm not looking at the dates, but I know the ones that I grew up watching were probably the older ones, like 50s and 60s, maybe.
We were just kind of talking about that too.
But here's the question I will pose to you: does that make Disney not good because the 80s were bad? Because that means that rock music is not good because the 80s were bad.
Ooh,
I mean.
That's a good point.
The 80s
you may have got me there.
It was not kind to fashion.
No, it wasn't.
Music.
Yeah.
Apparently movies. I mean,
pyro companies were really into it.
Here's the only thing I will say, because
the Chevy Camaro was a piece of junk.
Disney movies were not very good in the 80s.
Right.
However, movies in general were hitting a really funny stride in the 80s.
They were bizarre.
They were, but think about all the 80s movies that you...
I think
have you introduced
Disney,
your kids to some of those movies that you
have.
watched?
We watched Flight of the Navigator. That's a Disney movie.
Okay.
And that is the strangest
I'm thinking
movie.
Goonies, Short Circuit.
Yeah. Oh, yeah.
Back to the Future.
Yeah.
There were some good movies in the 80s.
Yeah, but that's different. When I think of Disney, I'm thinking of an animated.
No, I get your point. What I'm saying is movies in general.
Right. I get it.
You can't say that movies were bad in the 80s. They might have had a certain corniness to them. Mm-hmm. Disney movies were not great in the 80s. Everything was bad in the 80s, but I will say movies in general. So it depends on what you're judging
There's some
Disney by.
classics in there is what you're saying.
Sure, absolutely.
Yeah, you might have me on that point. So anyway, are we drinking or what?
Yeah, definitely. Today we're drinking something called and I gotta make sure I don't call this something else, an Irish Buck.
Ooh.
Irish Buck.
Is this in honor of St. Patty's Day?
Sure.
This episode comes out after.
We're recording it just before St. Patrick's Day.
We are.
So yeah.
So deal with it, people.
Yeah. The Irish Buck. Funny how that works out, huh?
Yeah, that's all right.
So I guess I'll just get into the ingredients and then we'll go from there.
It's pretty simple.
So this one I thought maybe we covered way back.
We've had other bucks.
Yes, we've had. So this is in the mule category.
Yes.
We did an episode that was all kinds of mules. It was cocktails on a budget or something like that.
That's right.
A really long time ago.
Find some liquor, mix it with
ginger beer. Yeah.
Off you go.
So I think with these, bucks or mules, whichever, and I'm not sure I remember the distinction between the two. I know gin was a gin buck.
Yeah, right.
Because you had gin, ginger, and then I don't know why it's not a mule. But this is also in the buck category.
Because mules are kind of like dumb pack animals.
Well, I think it might have something to do with whether you're using ginger ale or ginger beer.
Oh, that's right. I think that's what it is.
It may be. I'll tell you this
It doesn't matter. We're just expert drinkers at this point. Right?
Well, what the recipe called for, and we used ohlq.com, as I have
many times.
Quite a bit here lately.
They got lots of good recipes. Some really bad ones.
This was one of their St. Patty's Day themed recipes. But this is 1.5 ounces of Irish whiskey. We use Jameson. A quarter of an ounce of lime juice.
Okay.
And then this calls for 2 ounces of ginger ale.
Okay.
I use ginger beer.
So ginger ale, sweeter, less bitey.
Yeah, I like the tangy zip.
So do I. Yeah, and this isn't even our favorite ginger beer. I mean, so
it is kind of in the spicy category.
It is.
Like
it's spicier,
but I think Fever Tree.
Yeah, that's better than.
Yeah.
What's the one that comes in the brown can?
There's one called like Bundaberg or something like
that's
that.
What I was thinking
and that's very honey tasting.
Yeah, it's kind of like sweet taste.
And then there's Gosling's, which is
not
kind
great.
of like the Sam's Choice. I don't know. You find it
the
everywhere.
Big K.
Yeah, that's not very good. But
all right.
So you know what? As far as Irish whiskey goes,
I'm willing to try it. This is kind of like
Jameson's all right.
Yeah, I mean, I will order at a bar when I know I'm not going to get a great drink. In particular, Kentucky Mule is probably one of my go-tos.
Oh, sure.
So I like a cold drink.
I'm sure we're going to like well, we know we like the bourbon version of this, right? Because we like a Kentucky Mule. So,
all right.
In honor of St. Patty's Day,
here we
go.
Yep.
That's not bad. It's refreshing.
It is.
It's crisp.
Yep. Maybe that's like...
I think ginger ale would be too sweet.
I think so, too. But I think that's just our preference.
Well, honestly, so Jameson's, it's a little bit of a sweet whiskey, in my opinion.
I would agree with that in comparison to other Irish whiskeys. But I always go to Jameson. I don't really dabble too much in the Irish whiskey category.
Yeah, so my uncle is a big fan of Bushmills and some of the different variations, and I'll say for a reasonably cheap whiskey, that's not. I mean, it's been a while since I had it. I don't remember it being too bad.
Ooh, future research.
Bushmills, yeah. They both have the screw tap.
Yeah.
Man, I can't talk. Screw top, screw cap.
Yes.
Okay. Yeah, same thing.
When I was out of the office a couple weeks ago, I watched How It's Made. How they make those things, it is fascinating.
How they make?
Yeah, it's really cool. I was intrigued.
This is not related, but sort of related as far as the screw caps go. If you notice Weller, right?
Yes.
The Weller Antique, the red one, a lot more sought after than the green, although I think in a lot of states, both of them are. The green comes with a screw cap.
Yep.
The red, or the Weller Antique, comes with a cork. But it wasn't always that way, actually.
Huh.
Some of the older bottles of the red, for a long time, they came with a screw cap. And it was cheaper, too. It was like $25 to $30 a bottle.
Interesting.
And then people started buying it up, and then it became harder to find, more expensive. They put a cork in it. But there are a lot of people out there who will say, yeah, if you ever get your hands on an old bottle of Weller Antique, it was better when you had the screw cap. So
you better know that it's not a fake. That would be my worry.
Yeah, so that's...
Lots of imposters out there, that's for dang
If
sure.
you walked into a liquor store, like, out of state or something like that.
ABC or something like that.
And you see an old dusty bottle, you might be wondering, is that a fake or is that the real deal?
If
like
it was
to get
reasonably
my hands
priced,
on one of those
I would try it.
Yeah, one of those old $30 screw tops. I'd pay the going rate for a new bottle.
Yeah,
not much more than that because I'm cheap when it comes to this stuff. But
yeah, exactly.
Yeah. Anyway, so screw caps.
Not too cheap. How many bottles of whiskey do you have? Undisclosed.
It's better than what it was.
Oh, that's good.
I think I'm under 50 now.
Oh, nice. You've been practicing.
I have been practicing.
Good job.
All
It is winter.
Well, let's transition then, Jason, into the finance topic.
Nice.
Kind of interesting coming on the heels of the anatomy of a bank collapse, or what did we call it? Anatomy of a bank failure?
Failure, yeah.
This will be kind of an interesting topic because we're talking about chasing yield today, right, Jason?
Yeah, this is really timely. And the crazy thing is when we were planning these episodes, several weeks ago, we didn't know that there would be any kind of bank failure or anything.
No.
So what we're seeing out there right now is a lot of folks are asking questions about what appears to be very attractive fixed, lots of air quotes, fixed rates that banks are advertising. A lot of other investment companies are also advertising these.
Yeah, like brokered CDs.
Brokered CDs, annuity rates, indexed annuities. These are they're definitely, the rate's definitely attractive enough for folks to take a look at and go,
It's been enough where for most of my career,
mine too,
I have kind of poo-pooed the idea of CDs in general, but have been forced to kind of step back and say, well, wait a minute, this money's for a down payment on a house in the next year.
Right.
Nothing wrong with a 4% CD for the next 12 months, right?
Exactly. And so I went back and I looked. I said, okay, when was the last time we had a CD rate, a 1-year CD rate that was above 5%?
I remember this because this was as I was getting into my career at a regional bank.
Mm-hmm. So the average across the country, it was 2010. Okay. And since then, there's only been like one little blip, like one tiny little blip where we hit 5 and then retreated.
Really? That's interesting. When would that have been?
And it was like in 2011-ish.
Huh. Okay.
And depending on which site, you look at, that's even debatable. But pretty clearly we haven't seen 5%, which I'm almost certain you could go get a 5% CD somewhere at this point.
There's a pretty prominent online bank advertising that rate right now.
Yeah, so this is, remember, a 1-year CD. So it's been a long time. I mean, 13 years is a long time. And before that, the average, it was lousy.
Yeah.
Okay, it was like the average wasn't a whole lot better. And in 2010, it peaked for a short period of time, and then it retreated. So most of our careers, we've heard inflation's coming,
and
inflation.
We're like, nah, they keep saying that big bad wolf, or we're like the little pig, right?
Exactly. And we got a decade in now, and so, but now we're here, okay? And so these rates are definitely popping up out there, and I think what clients are doing, which I think it's natural. Okay. And actually, I have a quote here. This is an awesome quote.
Okay.
It's Warren Buffett, of course.
Oh, all right.
I mean,
who's this?
Who's
this?
Warren Buffett.
Warren Buffett
this
Buffett that you speak of? Okay.
Buffett guy.
Related to Phoebe Buffet?
So it says, reaching for yield is really stupid, but it's very human.
Okay.
I like that. And I think he's touching on the emotional point here.
Mm-hmm.
And he's basically saying, usually you're reaching for yield when the markets are selling. Okay. And I want to be clear about this. We're talking about, there's a couple types of chasing yields.
Sure.
Right. You can chase yield in the market, dividend payers with, you could use bonds that have a lot more risk.
Mm-hmm.
That's not what we're talking about here.
Yeah.
We're talking about fixed rate, CD, annuities, and when the market is just simply not good.
Yeah.
Where we've had a period now where 12
Cash
months,
was the best performing asset class last year.
Yep. 12
that doesn't
months.
happen very often.
Yep. 12 months plus, and people are starting to get a little bit of exhaustion.
Yep.
And then they see a 5% rate advertised in the newspaper. They want to go get it.
In their head, what they're saying is 5%, and you can take the guesswork out of it. I don't have to think about it. I don't have to worry about it. Yeah, sounds awfully attractive, doesn't it?
It's one thing to take cash and put it into that.
Mm-hmm. Cash that's been earning
point nothing. Yeah. And for most of my career, I called a CD a certificate of depression.
Yeah.
Like, I think it was bad. So when the market's selling, folks are thinking, I'll just limit my losses and I'll go get that 5% CD, right?
Yeah, it's interesting because you say limit your losses, where you and I would say, so you're not limit your losses, you're going to lock in your losses.
Correct.
Right?
And you are locking in your losses. Probably, I mean, I'm going to take a stab at it and say you're probably locking those losses in forever if you don't return back to the market. Well, even if you do.
Okay, so
even if you do.
Maybe this is for later on in the episode here.
Another nerdy debate.
Yeah, and I guess we've had clients that have asked about this, and kind of going back to like what I said before. If you've got cash that's been earning nothing, and there's a use for that money in the next year, 18 months, 24 months,
right.
Maybe. Okay. Now you don't feel so bad biting the bullet and getting a 4 or a 5% CD, calling it a day, because you're going to use that money. It needs
Correct.
to be there. I don't know where the market's going to be in 12, 18, 24 months. You don't either.
Nope.
But it's different to take money out of the market, let's say, that, you could, at this point, you could be anywhere between 7 and 15%, I'd say, to the negative, right?
Yeah.
So you take money out, and we know to get that 7 to 15%, let's just call it 10%, you have to get more than 10% the next year to get back to break even.
Right.
So a 5% CD over the next year doesn't get you close.
No, it doesn't.
And I think where the real speculation comes in is you're assuming that you're going to be able to get 5% again when that CD matures.
Exactly. And actually, that is one of the points that I found very interesting, reading different sites, that folks assume that CD rate, interest rate risk is super low. That is not the case.
No.
It's actually highly, highly volatile. We don't know. Just imagine.
It caused a bank collapse, for crying out loud.
Yeah, exactly.
Yeah.
And if you think about this, any fixed rate, go back to the beginning of like 2022. It wasn't that long ago. You go into a bank, you're excited, you got a 3% CD for 5 years. Okay? Like, people were like spiking the ball in the end zone, right?
Well,
and so on this, and so now
we're really probably talking end of 2019 at that point.
Right. Exactly.
And I remember, because I was still working at the bank.
Mm-hmm.
And like you said, for most of our career, they were certificates of depression.
Right.
People would come in and they would ask about interest rates and be like, do you even want to know? Are you going to make me say it?
Yeah,
right?
Exactly.
And then we started raising rates, and maybe 2018, 2019, a couple of times.
Mm-hmm.
We started to see some promotional rates out there. We had at one point at the bank that I worked at a 3% money market promotion, and CD rates that were pretty close to it. And I did have some of those really, really risk-averse clients, and I'd call them and say, hey, look, I don't see this lasting, but 3% on a CD. These are the same folks who said, I'm not going to lock anything in. I'm not going to do the markets, but I don't want CDs. Or I don't want any of that stuff unless we can talk 3%. And then you go, hey, guess what? 3%. I think you ought to jump on this. And you know what it became? I think rates are going higher. I'm going to wait till 4%. Well, guess what?
You're there.
They were waiting until now.
Right. Which means they gave up the opportunity cost of that is a lot. And yeah, so I think what this comes down to for me, this is like a frustrating topic, okay?
Yeah.
It's really hard to talk about, though, right now. Nobody wants to, like, laugh all the way to the bank with, negative returns in their stock portfolios, right? I'm not excited about it.
No.
You're not excited about it. But we know. We hang our hats on the statistical probability of averages coming back to averages.
Yeah, averages are averages for a reason, folks.
Right. And the ability to withstand the fluctuation, right? So the first question you have to ask yourself, and you need to really ask yourself this question.
Do you feel lucky? Well, do you, punk? Oh, you're not going there? Okay.
No, I'm not.
I thought we were back to our duel.
I know. I'm not. I'm a little nervous. Yeah.
First thing you got to ask yourself.
I think I'm better with the gun.
Hey.
Ooh, that's not good. Anyway, I forgot what I was saying. You totally you just like
I'm good at sidetracking.
Yeah,
nobody's laughing to the bank with their
thanks.
less than their principal. Well, okay.
When you're losing,
quite
nobody,
honestly though, it's not less than if they've been invested. We'll go back to our conversation about anchoring in, right?
Right.
You look at your all-time highs and you say, well, this was how much I had in.
Right, exactly. Yeah, and my point is that honestly, ask yourself, am I going to use this money in the next 5 years? Ask yourself. If you are a 30-something person and you are child, human, I don't know. I don't even know what to call it.
That was interesting.
30-something human
person.
And you're working and you're saving for retirement, for the love of Pete, you are not going to touch that money till you're 60 flipping years old. Okay? So this doesn't stop.
5% for 4 or 5% for a year to 18 months. That's not making a difference in the retirement bucket.
Nope. And so the question is do you think you're going to need these funds? Okay. I think a lot of investors will convince themselves
that I might need it.
I might. You never know. I might have that opportunity. And 5 years goes by in a heartbeat. Mm-hmm. And so you really got to ask yourself that question. And most, like, we come from the perspective of, like, most investments we do, we can get out. Okay.
Oh, yeah.
Now, it doesn't mean that we want to get out when the market stinks. But if you are sitting on dry powder and you have the opportunity to get into the market when it stinks, this is a highly emotional thing, right? So I looked this up, okay?
On the Google?
Yeah, on the Google told me buying when there is blood in the streets.
Oh yeah.
That is the headline.
Yeah.
Okay. I love this. If you would have bought in 2009, 3909.
Wait. Before you do it, because I have an anecdote and I think it lines up with what you're about to say so well. Okay.
Anecdote me.
Anecdote. I was working at the bank and I saw the tail end of some of these 5% CDs maturing.
Yep.
And I remember calling clients to tell them, hey, your CD's maturing. You have 10 days to figure out what you want to do. So the bank that we worked ran a 5% CD promotion.
Ooh.
And it was name your term, right?
Oh.
So you could do 1 year.
I didn't know you had this experience. I was using this story in meetings.
Yeah. 1 year, 2 year, 3 year, 4 year, or 5 year.
Pick your term.
Pick your term. What did
1 year,
everybody
all
pick?
All day long.
Everybody picked 1 year.
Oh my gosh.
Except for a few nice little old ladies that came into my office and said,
I would be happy with 5%.
I understand that we have to do something with a CD. I'd like to just let it roll over. And I said, I don't think you want to do that. And she said, I sure do want 5% for 5 more years. And I'd say, ma'am, I wish you could do that, but that ain't how it works, right? So what's funny about that is I had some of those conversations and they say, boy, those folks should have been buying 5-year 5% CDs.
Yep. Should have.
And if I could go back knowing what I know now about what's happened, that's what I would have been doing. And in my head, I'm going,
you're so
that's
wrong.
Loser talk, man.
That's loser talk.
If you could go back in time, you should have been buying into the market.
Yeah. So the trough, 3909.
Yeah.
We were down 56.8% in the S&P 500. That's a kick in the shorts.
Yeah, you think it's bad now?
Yeah. Those are, well, by the time this airs. Don't jinx us, dang it. If you were invested 1 year, negative 6.9, you lost.
Man, you lose, Jason.
You lose. 3 years.
Good day, sir.
3.7%. Shouldn't have drank the fizzy lifty drink.
Yeah.
Shouldn't have done it. Okay. 5 years, you're up 61.2%.
Is that good?
10 years, you're up 20 point, or blah, blah, blah. These are big numbers.
Yeah.
209.6%. Divided by 10, that's 20.
Missed the decimal place there,
That's 20%. Come on, people. That was really scary.
Yeah.
Okay? And everyone says, well, you got to buy low, sell high. This is your opportunity, people. Like now.
We're lower. We set a high in January of last year. We're still not back there. Therefore, we are still buying low. Does that mean that we can't go lower than we are today? Absolutely
not. But this time is different. This time is
it
different,
always
right?
Is, isn't it?
Every time that we've peaked and troughed, 1962, 70, 74, 82, 87, 02, and 09, the average 10-year return when you put in near the trough, 213.7%. You're up 21%.
Yeah.
Over 10 years.
You know, my only argument to this, Jason, is that I don't think things are all that bad right now.
I understand.
Right? We're talking about going back to 08, 09 when it was.
My point is you're running after a 4 or 5% return, thinking it's the end all be all, when history has shown us that buying when it's real, when there's blood in the streets, is fine. It's actually when you should be buying.
Do you think it's blood in the streets? Yeah?
No, not even close. Do you
think we're going there, Jason?
No.
I mean, eventually,
it's
at some point, we
yes.
will.
And in the rest of my career, probably. Okay. So, but I know the S&P over the last 10 years has averaged 11.67%. That's data as of today when we're recording.
Today.
Yeah, March 13th. So like. The problem is we have volatility in the market.
Yeah.
And the volatility swings 20.8%.
The great equalizer.
Right. So, you're talking about like literally being on a swing. you're just trying to get to the point when the swing stops at 11.67%. I'm not the smartest guy in the world, but I am a thinker. Most people are happy with 11.67%. Most. Okay.
Well, what I've found, Jason, is most people just aren't happy one way or the other.
Don't talk about yourself like that.
I've had conversations with folks about why we only got 20% in a year when the market did 25 or whatever.
But we're not having that conversation now, are we?
We certainly are not.
No. No, I mean, we had a couple years ago, had that conversation with clients where it's like, oh, we should have put the throttle down more. And, I'm kind of grateful that we didn't.
Well, here's the other
diversification means you have to say you're sorry, right?
All the time.
All the time.
Diversification never made anybody rich, but it keeps people from going broke all the time.
Jumping off buildings, right?
Yeah, I hope so.
Yeah. And so, again, I think like a big part of this isn't I want to revisit. This is emotional. Okay. Our logical brain, I can show you all the numbers in the world, the facts, the figures. And if you are just can't get over the emotional part of this and you will be up at night, that's unfortunate. It really is, because I almost have the exact opposite emotional feeling, like, conviction that's so strong.
Yeah.
That you have to buy when it's hard.
When people are giving up, that's when I start to go, call me crazy, but
yeah.
Are things going to be better in 5 years?
We've been watching regional bank stocks like get hammered, right?
Yeah.
Okay. And
some of them down 20% intraday.
We both said that. We're like, man.
Do I wait a couple more days, or is now a good time?
I'm not really that greedy. So if it goes down another 5 or 6 or 10 or 20, like, I can wait.
Yeah.
I don't know. Gosh. I get fired up about this one.
Well,
it's frustrating to me because it's in the newspaper.
Here's the other
People
thing to
listen
think
to
about.
that.
Well, they do. They listen to media.
Yeah.
We talked last week about listening to the stock pickers out there and things like that, and almost a surefire way to do the wrong thing at the wrong time every time. But what's funny about all this, we're talking about 4 or 5%, and people are excited about it. Give it a little bit.
Yeah.
They're going to be complaining about their 4 or 5% too, because what they're going to ultimately go back to is, well, I remember when a CD was 12%, and that's when I can say, you know what, I don't, but I'm a student of history, and that wasn't a real good time either.
No, wasn't.
That was hyperinflation, and I know for a fact it was always the people who said, I remember 12% on a CD. Say, no, you remember when other people were getting 12% on a CD because you were paying 15% from
on your mortgage,
borrowing.
Right? And your family lost their farm.
Yeah, wasn't a good
car.
Wasn't the good old days after all?
Exactly.
Right?
Oh boy.
I'm sure. Let the novelty wear off a little bit. You're going to be complaining about the 4 or 5% CD.
Yeah, I think you're right. And again, I come back to that point, which I'm trying to drive home here, is do you believe in investing or not? Okay? Do you believe in it or not? And I think you need to ask your planner that same question. Is investing in a fixed rate really investing?
I would say it's not investing. I would say it's saving.
I agree.
You don't save your way to riches, by the way.
You don't?
No.
Oh. Okay. You're right.
I just don't think you do.
You don't. You don't. You have to take a little bit of risk.
Absolutely.
Yeah. And this is highly calculated.
Here's the
I'm
other.
all fired up now. I'm like sweating.
This is my personal opinion. I think this is a spike. This is a blip on our radar. Mm-hmm. And I've told you multiple times we've talked about this, maybe not on the podcast, but there's a pretty popular mutual fund family out there. I won't say who it is. I think their research is great. Mm-hmm. Some of their funds are pretty good too. But there was a report that they put out probably back around, it would have been like 2013. Yeah, I would guess. They put out
like fiscal cliff worries and all that stuff. Yeah, quantitative easing.
And we were really, with all the stuff that was going on with countries defaulting on debt and all that kind of stuff.
That's right. We remember Greece. We were worried about Greece.
That was
and
a
Italy.
Big deal. Which it's still a thing, but
I know it is.
We don't talk about it. But
we just turn away.
They were talking about how everybody has this idea that interest rates have to go up. They have to go up.
Absolutely.
And they did a study that showed, not so fast, my friend, to borrow words from Lee Corso. What they showed is basically whenever interest rates, when the 10-year Treasury yield dipped below 4%, which it did back in 2008, 2009 on purpose, it's not something that we get through in 5 years.
Right.
That historically, that was like a 30-year cycle, and there were blips on the radar. Right. Okay. But I'm looking at this and saying, okay, well, could we get back up north of that 4% number on the 4-year? I guess we could, but we would only be about halfway through the average cycle there at that point.
Right.
And let's not forget looking at, the bond guys, the smart guys in the room, right?
Mm-hmm, mm-hmm. They're not banking on that.
They're not. In fact, the bond markets are betting on rate cuts by the end of this year. I've heard as early as September.
Yeah, and you can see that in yields across the board. It's just right there. So just remember that.
We're dealing with inflation now.
Yep.
We're dealing with elevated interest rates. I would submit to you, my opinion is that this is not going to last very long, and we're going to be back to low interest rates for a while.
Well, I don't think we can put the force against the headwinds of the globe. Mm-hmm. The United States has been the world's superpower when it comes to currency, and it doesn't matter what your opinion is. That's just what it is at this point. Mm-hmm. I don't think that's going to change overnight. And I think that it's really hard to fight the globe when we are the strongest currency in town paying the highest return on our treasuries. It's just not going to continue forever. I tend to take your stance as well. And I think we are in a period of time where we could see rate cuts. We really could. Mm-hmm. And, now it's marked down in stone and we have to live by it. Crap.
Oh, yeah, because the Fed's going to announce here
Wednesday,
a week before this episode comes out.
That's right.
Oh, let's see how smart we are.
Ooh.
This will be fun.
Yeah, this will be fun.
Not.
I'm
having a great time.
I think that's the second time we've quoted that.
All right, well, let's wrap this up. Thanks for having a drink with us this week, folks. It's time to close out the tab. If you have a question or a topic you want addressed on the Old Fashioned Finance Podcast, be sure to email us at podcast@bluejfg.com. We'd love to hear from you. Don't forget to share the show with someone you love or just someone who needs a little money muddling themselves. You can stay up to date with the latest action by following us on Facebook. Old Fashioned Finance is brought to you by Blue Jay Financial Group. That's bluejfg.com and produced by Podastery Studios. We've been your hosts, Caleb and Jason.
Cheers.
Cheers.
Yeah.
Did we even say if we liked this or not?
Mine's gone, so I liked it.
I liked it.
Yeah.
For it.
For 2 days.
Blue Jay Financial Group, LLC. Blue Jay is a registered investment advisor registered with the state of Ohio. Registration does not imply a certain level of skill or training. The presence of this advertisement on this podcast shall not be directly or indirectly interpreted as a solicitation of investment advisory services to persons of another jurisdiction unless otherwise permitted by statute. Follow-up or individualized responses to a consumer in a particular state by Blue Jay and the rendering of personalized investment advice for compensation shall not be made without first complying with jurisdiction requirements or pursuant an applicable state exemption. All verbal and written consent on this presentation is for information purposes only. Opinions expressed herein are solely those of Blue Jay unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.